This conference will now be recorded.
Okay, we've been looking at the master budget process and calculating break-even operating loss, operating profit. And we looked at this, in the context of it, but that you needed to understand and know these three formulas and how to calculate your unit contribution margin and be able to calculate sales quantity at break even, target profit, and target. So those were the things that we were working on. And, it's going to be hard to pass anything else in the course. And the course itself can't do these because on everything we do, this is the starting point. This is the starting point. And of course, we're using the contribution margin income statement. We began looking at this problem where our we had different percent sales each quarter. To stay in business, we would have to determine quarterly whether we had enough cash in, and if not, to come up with a line of credit prior to the year beginning so that we can make these calculations. Well, the starting point and the first thing you got to do is calculate break-even quantity. You got to calculate quantity. And if that number is wrong, everything you do on your cash budget will be wrong and your financial statements will be incorrect. And for your project, the same thing. So the reason I'm having you to work extra hard and, redo those quizzes, I want very comfortable because if the calculated break even fails, and you got to do that as well as the target profit, target loss, and everybody on the team has a budget year they're working with. Uh, if those quantities are wrong, everything you do will be wrong. So you want to make sure that you're with that. So in this problem, we worked on the first year to break even year. Said the sales were going to be 20% in the first quarter, 10% in the second, 10% in the third, 6% in the fourth quarter. Okay. And we went and we calculated the break even sales by looking at the administrative expense paid quarterly was $1 million. We got to get that on a year's basis. So that's $4 million. Our contribution margin is simply what? The cost of the books, 20. We had a selling price multiple of 3. And so our selling price in this problem is going to be 60. So the selling price multiple is 3. We only got one one cost 20. So 3 times 20 give us a selling price 60. The selling price of 60 and the cost of the books 20, that difference becomes our contribution. That is 40 is how much each book contributes to covering a fixed cost and the making. So we have the fixed cost 4 million. We calculate selling price 3 times the cost, 40, and then we divide the 4 million by 40 to get 100,000 in the break-even year. Question of what we did. Can everybody calculate and get 100,000? Is there anybody who can't get 100,000? Okay, so let's look at what we did. We prepared this cash budget and we put in our percentages 20, 10, 10, and 60 to get to, the 100%. That broke down to 20,000, 10, 10, and 60 for total quantity sold of 100,000. Selling price was 60. Our sales in the first quarter was $1.2 million. The 20,000 times the 60. We began the business with 100,000 in cash. Keep that amount in there. Our cash available is $1.3 million. The cost of the books, we had to buy 20 for books, $20 each. That's 400,000. Our administrative expense is $1,000 a quarter, so our total disbursements were $1.4 million. We only had cash available of $1.3 million, so we were short 100,000 for paying, all of our expenses. So we would have to have a 200,000 loan so we can keep 100,000 in the bank. Are there any questions on what we just did? Because on the project, there'll be a loss of $100,000 a year where we have to do all of this, including journal entries. There'll be a break-even year, $1 million profit year, and a $2 million profit year. And the team leader will sign those years, and everybody has to go through and calculate one of these tables, okay? Everybody will have to calculate a table and do everything else that we're doing today. Make journal entries, uh, prepare financial statements, and closing entries. There's a budget, and we'll see that when we work on the $1 million budget today, but there's a budget every year. And so everybody on the team is going to have a budget. And I'll be grading each year for the person who worked on that year. Any questions? Okay, let's continue with this year. We need to get an income statement and we need to get a balance sheet. Therefore, we have to make journal entries. The first journal entry, when we started the business with $100,000, we debit cash for $100,000 and we credit common stock for $100,000. That's the first journal entry that we make. So we're going to debit cash for $100,000, a permanent account, and we're going to credit common stock for $100,000. And going through retained earnings, these are all the permanent accounts that are going to be on the balance sheet. And of course, the assets have to equal the liabilities and equity. Posting of our first journal entry. The second journal entry we had was our cash sales of $6 million. So we would post that entry, debit cash $6 million, and we would credit the temporary account sales $6 million. Then we bought the books for 2 million. We debited cost of goods sold and credited cash for 2 million. So let's go post that. So we crediting cash for 2 million. We debiting cost of goods sold for 2 million. The next journal entry that we made, we paid the administrative expense 4 million. Debit administrative expense, credit cash 4 million. Then we're gonna post that. So we're crediting cash for 4 million. And we're gonna go down here and debit administrative expense for 4 million. Because if we can get our account balances, then we can prepare the financial statements. So just as we began the course, making journal entries and posting to the ledger, we ended up the same way. So we got the cash budget, but we got to prepare the journal entries. When we prepared this cash budget, it turned out that we needed to what? Borrow 1,400,000. Okay, we had to borrow 1,400,000 because when we went through each year, each iteration, there's 1,400,000 that was borrowed. So if we borrow 1,400,000, we have to make a journal entry, debiting cash and crediting short-term note. Then we paid it back because we had sufficient cash, and so we would debit short-term note and credit cash. So now we're going to have to post this entry. So when 1,400,000 came in, we debited cash for 1,400,000. We credited the short-term loan for 1,400,000. Then we paid it back. We credit cash for 1,400,000. And we debit the short-term loan for 1,400,000. We're just going through this, but this is, what we were doing yesterday with T accounts. We made the journal entries. We're posting to the T accounts today, which you will have to do on your project. Are there any questions at this stage of what we've done? We doing the problem we worked yesterday? So
Yes, I have a question. I've been scrolling to trying to find the T accounts on here, and I can't find it on the
I
document.
just put those on there today. So just make
Oh,
them, and then I'll send this to you soon we finish
okay.
with this.
Okay, thank you.
I, I have to keep working every day. So, you know, typically, uh, we just do it in our heads, but it's probably easier with a good point. So I will update this. So you'll have it with the T accounts on it, and I'll do that shortly. Okay. Now we need some closing entries. But let's in our accounts now. How much we got in cash at this point? What's the balance in cash? much money is in the cash account? Hopefully 100,000. There's nothing in receivables, nothing in say, short-term loan. That's zeroed out. Common stock has 100. We don't have any retained earnings yet. In our temporary accounts, we have sales of 6 million, we have COGS of 2, and administrative expenses of 4 million. And so, knowing that these are temporary accounts, we know that they're going to go on the income statement. And so, in preparing the income statement, sales 6 million, less the COGS 2, administrative expense 4, 6, 0. We break even, which is what we're supposed to do. Next, we need a balance sheet. So, how are we going to get this balance sheet balanced out? What we're going to do? How much retained earnings do we have at this point? Let's go and make the closing entries. So the purpose of the closing entries uh, is to close out all the temporary accounts. We close out sales. We debit sales and credit income summary. Then when we post that, we're going to have a debit to sales of 6 million. That will close this account out. These accounts are always closed out at the end of the year. And we're going to debit income summary for 6 million. Then our next second closing entry, we close out the expenses. So we debit income summary and credit cost of goods sold and administrative expense. Debit income summary, we credit in cost of goods sold and administrative expense. Now, I may have put that on. This actually, the initial one should have been a credit. Because we debited sales and then credited the income summary. Then when we, on these expenses, when we credit, then we go debit income summary. We're going administrative expense. So now the accounts are closed out. And we would debit income summary for 6 million. And because it is the break year, there's nothing to transfer to retained earnings.
Professor, you there?
Hopefully it's recording. We will calculate the number of books that need to be sold to produce a profit of $1 million. Okay. And we sort of did this for last time. But when we have a target profit, we had a break even as that formula. A target profit is the fixed cost plus the target profit divided by that same 40, and we came up with 125,000 as the quantity that's going to be sold that should produce $1 million. So what is your charge? You got to prepare a cash budget like this uh, based on 125,000. So after you put these numbers on your cash budget, I'll go down here too. First thing you putting on that budget is 125,000. Then we would use these same. So we start on this a little last time, and you should have it. So what you've got to do now is to finish this cash budget. After you finish the cash budget, you got to make the journal entries. This journal entry would not repeat because you already invested. But you need this journal entry. You're gonna need this journal entry. You need this journal entry. If you borrowed money and paid it back, you'll need journal entries. And then you need the closing entries. This is closing entry 1,
You're
closing
you're
entry 2.
kind of you're kind of cutting out in the beginning. Can you repeat that?
Okay. Where you want me to start at?
The the entries, like just the beginning, to be honest,
Okay,
please.
closing entries. Well, the journal entries. First of all, you're going to make these same journal entries except the first one. You don't have to make that one. But based on what's in your chart, you got to make the cash sales, the costs. So you look at the numbers, administrative expense. If you borrowed money, you debit cash and credit short-term note. If you paid it back, you debit short-term note and credit cash. Then you got to make closing entries. Same closing entries, except you're supposed to have a profit. And since you have a profit, you're going to have that uh, third closing entry now. In that third closing entry, you should be debiting income summary and crediting sales. You have to calculate that amount. You will have these T accounts to work with, and I'm going to save this and send it to you. Uh, the temporary accounts are all zeroed out. The permanent accounts are still here. You got 100,000 in cash, and you got 100,000 in common stock. So I want you to do year 2, which is the $1 million year.
This is homework.
Yes. Is there? Okay. So Let me see if I can get this sent to you, updated into. I'll put this updated one in Blackboard. So under the master budget attendance quiz, you should have the updated out there now, the T accounts and everything. Does anyone see that? Has it shown up yet?
It's loading.
Oh, so at this in the course, we're halfway through, and it's not so much what we've done in the past, what you got to do in the future. You got to get your project done, looking good like this. And you're gonna have some financials to do. You see now, and since those financials might be good, you need something. Press me